Hello and welcome back to my channel McNallie Money, home of all things stock, investment, and personal finance related. Now the market has been downtrending for the last couple of months. It's been a really sketchy time to be invested, so I wanted to take a second and walk you guys through 3 trade strategies that you can use or deploy in times of bear market conditions to actually make money as the market in general moves down. So in this video, I'm going to outline each of these 3 strategies, but before we get into it, please take a second, hit the like button, you guys. It's a huge help to me in the channel. If you're not already subscribed, McNallie Money, feel free to do so. And let me know in the comment section below what you think of these 3 strategies, if you're using any of them in your own portfolio, and how you think the market's going to react over the next couple of months. Now, I personally respond to each and every comment, so this is a great way to get a hold of me, and I'd love to hear from you. With that being said, let's get into today's video. Okay guys, so that's right. In today's video, we're going to be going over 3 simple strategies that you can use or deploy in times of peak market volatility or bear market conditions like we're seeing right now. Now, as a refresher, a bear market by definition is any time that a stock, index, or overall market is off 20% from its peak. So that's exactly what we've now seen enter in the S&P 500. We're seeing many high quality businesses that are actually down in excess of 50%. So although the overall market is down around 20%, we're seeing individual stocks down in the neighborhood of 50, 60, 70, some cases 80 or 90%. And we're actually going to talk about a strategy related to put options to take advantage of those individual stocks as well. Now, obviously bear markets are very uncomfortable, especially for first-time investors. It's really difficult to see the value of your portfolio continually decline on a daily basis. But honestly, if you're in this for the long run, you guys, this is a time when true wealth is generated or created. And if you're able to layer in a few of these trade strategies and actually capitalize on the downtrend as well, it's a great opportunity to build your portfolio and actually add great companies at discounted or on sale pricing. Now, emotions run high. You can see that's the 4th point here on this article from Seeking Alpha. And for me personally, this was the most difficult part of investing, is actually separating logic from emotion. And you need to make sure that each and every trade you're making in your personal accounts is based on logic or a logical strategy rather than using those knee-jerk or impulsive reactions based on emotion. So with that being said, we're going to move into the first of these 3 strategies. And again, the underlying theme here, you guys, is look at bear markets as an area of opportunity. This is a great time to accumulate shares of great companies or overall ETFs or index funds at discounted prices, and really try and remove or eliminate the amount of emotion, especially negative emotions, that you're feeling during these times of market pullbacks. And again, keep in mind, you guys, you're not out there alone. Everybody's in the same boat. And for the most part, unless you're Meet Kevin and you timed this perfectly and sold out of all your equities, everybody's portfolio is down and everybody's feeling the same pain that you are right now. Now, the first of the 3 strategies we're going to talk about in today's video is really one of the most easy to execute, or the simplest in terms of taking advantage of market volatility to the downside. So this is going to really focus on purchasing what's called inverse ETFs or inverse funds. So one example of this is the ProShares Ultra Pro Short QQQ, also known by its ticker symbol as SQQQ. This trades on the NASDAQ exchange in the United States, and this fund actually seeks to replicate the inverse moves of the top 100 largest companies, whether they're international or domestic, listed on the NASDAQ exchange. So what that means is as the NASDAQ moves down, or those top 100 companies on the NASDAQ move down, the SQQQ is actually going to move inverse to that or up. And you can actually see over the last 6 months here, you guys, we've actually seen the SQQQ increase in value by 45.5%. So this is a great way, you guys, to take advantage of short-term market volatility to the downside. Now, one thing I wanted to bring up here, if we actually look at the bear market since 1950, on average, you guys, these aren't long-term trends. So you can see the last 3 that we've gone through, whether it's 2011, 2018, or 2020, the most recent one here, they actually lasted less than 6 months, so under half a year. So one thing I wanted to caution you with here, you guys, is if you're using this strategy, Keep in mind, this is a short-term trade. You don't want to be holding these things for long durations of time. Because they're inverse ETFs, they use leverage trades and they actually have to rebalance each and every night. So you'll see over time, if we actually zoom out to a 5-year chart, these type of funds are actually going to decrease in value over time just by the way the fund is structured. So this is definitely something you do not want to hold longer than you need to. But again, it's a great opportunity to make some money over the first few months of a bear market downturn. And a lot of times what you'll see these type of funds do is actually reverse splits. So they'll consolidate their shares in order to keep their share price at a minimum level. Now, another example of this type of fund is actually the TZA. This is one that I've personally traded. It trades on the New York Stock Exchange. Both of these are as of close on May 27th, you guys. This one's a small cap bear ETF, but it's 3 times leverage. So not only are you going to see moves here inverse of what you would actually see with these small cap companies, but it's actually 3 times levered. So you're going to see much more dramatic moves, whether it's to the upside or the downside. And this one actually seeks to replicate the top 2,000 companies in the Russell Small Cap Index. So again, over the last 6 months, you can see this one has appreciated despite the market downturn we find ourselves in the midst of. And if you look over the past 6 months, the TZA is actually up over 30% again since those highs we saw at the end of November. Now, the second strategy you may want to look at when the market is crashing and you're seeing a lot of stocks hitting 52-week lows is actually an option strategy leveraging put options. So by definition, a put option is a contract giving the option buyer the right but not the obligation to sell a specific amount of an underlying security or stock at a predetermined price. So if you think about this, if you're buying put options, you're actually reserving the right to sell that stock at a predetermined price. So what you can do here, you guys, is deploy this strategy on individual stocks. It does work on the overall market as well. But as we discussed in the intro, a lot of times the overall market will stand up better than individual stocks. So if you really want to maximize your profit here, put options are best served on individual shares of a company. So if you take a look at some of the top stocks in the market, Tesla is one that comes to mind, a very popular stock for retail investors. You can see back in April, you guys, Tesla was trading in the neighborhood of about $1,150 US. And we actually have seen Tesla bottom out at $628 on May 24th of this year. So you can see they virtually cut their share price in half here, you guys. And this would be a perfect opportunity to buy put options on shares of Tesla. So for example, what you could do here is buy the option or the right to sell shares of Tesla, say at $1,000. And as we see the price of these companies decline, you would actually keep the delta. So for example, if you had a put option on Tesla, the right to sell shares at $1,000, and you actually saw Tesla shares drop all the way down to $630, you would actually be able to exercise that option and keep the difference as your profit. So in that situation, you'd be looking at $370 US of profit. Each option contract represents 100 shares, so you'd multiply that by 100. So you would have just made yourself a profit of $37,000 US per contract, minus whatever the initial cost of that contract actually was at the time of purchase. Now, obviously that's a huge return, but keep in mind, you guys, when you're buying options on companies like Tesla that are trading near $1,000, the actual contract cost itself is going to be quite expensive. So with that being said, if you're looking to deploy this strategy, you may want to look at companies that are trading at a lower overall share price. So Meta, for example, or Facebook, we've seen a dramatic sell-off in shares here. You can see December, we were close to $350 per share. We're now trading under $200. So this would have been a prime example of a put option candidate. And another super popular retail stock that's talked about all the time on YouTube, Tattooed Chef, TTCF. This one has sold off dramatically over the past year. So if we actually look back to May of last year, this was a $22 stock, you guys. It's now trading in the $7 range. So again, this would be a great example of somewhere you could purchase put options, make a ton of money off those contracts, and you don't actually have that initial upfront cost like you would with a company like Tesla or Meta that are trading in the multi-$100 share price range. Now, there are a number of factors that actually impact option pricing, whether you're buying calls or puts. So I would definitely encourage you to take a closer look before you do any option trades. A lot of times you actually have to get special approval in your trading account to trade options. This is definitely the most complicated of the three strategies here, you guys, but definitely some value to be had if you can master this trade strategy. Now, you also want to keep in mind timing. There's metrics like delta, theta, intrinsic value that you want to keep an eye on. And keep in mind with options, you don't actually have to hold them to expiration. So you can sell these option contracts to other investors after you've met your predetermined price target or overall profit or loss target. So that's a great strategy. And when I'm trading options, I rarely ever hold them to expiration, and I'll actually unload these in advance to really avoid the impacts of theta or time decay on my initial investment. Now, the third strategy here, you guys, is probably the most simple one and the one that I would recommend for most investors out there, and it really talks about dollar cost averaging. So what we have here is a historical view of the S&P 500's PE or price to earning ratio over the last 100 or so years. Now, obviously a lot of things have changed. So if we look back to more recent history, you can see since 1980, we've really seen a range in terms of the PE ratio from about 7 in 1980 all the way to about a 43 in the early 2000s, up to an all-time high in excess of 70 in 2008. So what we see here is a wide range, you guys, and what we've actually seen in the last year or so is we're flirting with some of those all-time highs we've only seen a couple of other times in history. So if we look back to the end of 2021, so again around November of last year, we saw an overall PE ratio for the S&P 500 in the neighborhood of about 33. So if you think about investing at its most simplest form here, you guys, you want to buy low and sell high. So obviously you don't want to be purchasing the majority of stocks or overall funds or index funds at these peak times in history. And what we've actually seen now in the last couple of months is the PE ratio for the S&P 500 drop down to about 21. So if you look at the median over the last 100 years, we're actually still quite above that average. But if you actually zoom in and you look at recent history since the year about 2000, we're actually starting to trade very close to that historical PE average, which is starting to indicate a great time to actually be dollar cost averaging or buying in to overall index funds. And I think for the majority of investors, this is the best way to make money in the stock market over the long term, you guys, is consistently be buying stocks month after month. And when you see periods of weakness like this in the overall market, this is a great time to deploy extra capital into some of your favorite companies or overall index funds. So a couple examples of that would be number one, the QQQ. So this is the opposite of the SQQQ that we just talked about on the first strategy. Now you can see over the past 6 months, this one has been downtrending at the exact same pace as the SQQQ has been uptrending. Again, they're inverse or they act opposite of one another. So this, again, if you look at a 5-year chart here, you guys, represents a major pullback in the overall QQQ value. We saw highs at the end of last year in the neighborhood of about $400, and we're now trading close to $300 US. So this would be a great opportunity to pick up shares at about a 25% discount to what you could have just a few months ago. Another great example here, you guys, is the Vanguard Total Stock Market Index Fund. Trades under the ticker symbol VTI. This is a very popular one with super low fees or expense ratio. And again, over the last year, we've seen the VTI decline from about $241 all the way down to a low in the neighborhood of about $195. So again, for the long-term investor, you guys, if you zoom out to a max view, you can see that over the long run, total index markets really do perform quite well. And if you're looking for a hands-off strategy to make money in the market without the stress of individual stock picking, this is a great strategy and a great opportunity or time to deploy money into these type of funds. So that's it for today's video. 3 simple strategies or relatively simple strategies to make money in times of bearish market volatility. The first one is actually to trade inverse ETFs. The second one is to look at put options. And the third is just to continue to dollar cost average into some of these overall index funds and use this pullback as an opportunity to actually accumulate more shares at a better price to bring down your overall average cost of that investment. So I'd be super curious to hear your thoughts in the comment section below. Have you personally been trying any of these 3 strategies? Which of the 3 do you like most? And how has your portfolio held up over the last couple of months? Now, if you're still watching the video at this point, hopefully you found some value. So make sure you hit the like button, you guys. If you're not already subscribed to the channel, McNallie Money, feel free to do so. And with that being said, that's all for now. Thanks for watching and have a great rest of your day.